Now, manufacturing is staying robust in the world's second biggest economy, even after a series of rate hikes. Well, our next guest is a leading analyst on China. Jonathan Fenby has written 5 books on the country, including an FD Book of the Year for 2008. He's also co-founder of emerging market researcher Trusted Sources and heads up their China research team. And I'm very pleased to say that you join us now live from Paris. Jonathan Fenby, can I just get your reaction to this PMI data? Because it was a lot higher than virtually everybody was expecting.
Yes, well, I think a kind of pessimism has found its way into the market and into a lot of analysis about China in recent months. You know, a lot of talk of hard landing, more tightening, the economy contracting, and so on. Whereas, in fact, all our analysis has shown that China is still on course for a 9% GDP growth this year, and this PMI figure is very much in line with that. And looking ahead, of course, you've got the fairly flat summer season, but then probably a pickup in activity shown by those new orders in the autumn, restocking of inventories. There's no real sign of a hard landing as yet. OK, a softer landing for China. Is that enough for the Chinese authorities? If Wen Jiabao says getting inflation down is his #1 aim, this really isn't going to help, is it? Well, no, although what you have to remember is Chinese inflation is driven very largely by food. It's food prices, most recently pork, previously it was fruit and vegetables, and manufacturing inflation is actually very low still in China. So the real question for the coming months is whether the authorities can bring down food prices, and you're going to have a purely arithmetic effect kicking in during the third and fourth quarters of this year, because that's when inflation spiked last year. So in relative terms, the government may be able to declare victory around about September, October. Well, what are the options for the Chinese authorities in tightening monetary policy, in loosening it? What have they got to play with? I think they're probably quite happy. I know it's not fashionable to say this. We always have to say China is either headed for a boom or a bust. But I think the authorities are probably pretty happy with the way things are going at the moment. And the property market, for instance, increases there have slowed down, but it's still going ahead at a rate which will keep middle-class investors happy. So I think it's, you know, kind of steady as you go, muddling through till the end of this year. This isn't perhaps a very exciting story compared with some of the boom and bust stuff we've had out of China over the years, but this is the way that Wen Jiabao and co want it to be as they go into the vital year of 2012, when there's a wholesale leadership change, and they want everything smooth then. Talking of muddling through, we now have this debt agreement in Washington. Will there be relief in Beijing that this has actually happened? Let's not forget, it's China that holds the vast majority of American debt. Oh, yes, absolutely. I mean, China is caught in the dollar trap. They don't like having all this huge pile of T-bonds and other American assets, but there's really no other market that can absorb the kind of surpluses that result from their trade. But it's above all, I think, on the export side. One thing China is still frightened of is a new dip in the US, which would cut into exports, which are still very important for China. So this will be certainly news that will have been very welcomed in the leadership compound in Beijing. Jonathan Fenby, delighted to talk to you. Thank you very much indeed for giving us your insight here on Bloomberg Today.